Hello and good morning, everybody. Welcome to this November instalment of the NZX Virtual Investor Webinar Series. Somewhat amazing, we are in the back end of 2022. My name is James Sharp. I'm a Senior Relationship Manager here at the Exchange. Just a few points to note before we kick off. This is a live Q&A session, so we're going to hear 3 presentations for about 15 minutes or so. There'll be room for some Q&A after each of those presentations, 5 minutes or so. So to ask a question, please do so via the webinar panel. There is a chat box there. You can ask your question anonymously, and we'll cycle through as many of those as we can today. And anything we don't get to, we will of course address after today. So without further ado, I'd like to welcome our first presenter, Simon Woodhams, CEO of PFI Property for Industry. Property for Industry, after first listing in 1994, has grown to be at the forefront of the industrial property market in New Zealand, with a portfolio of 97 properties valued at over $2 billion. PFI invests in quality industrial property in prime locations, adopting a focused, disciplined and conservative approach to risk. Simon, over to you. I'll be back in a few moments with some questions. Thank you.
Thanks, James, for that introduction. Good morning, everyone, and thanks very much for giving up your time and listening in today. We really appreciate that. Today, I'm going to give you a very high-level overview of PFI, just conscious that we've only got 10 to 15 minutes. We'll talk about what our purpose is. We'll run through a couple of the recent results that we announced back in August. And then I'll touch on current themes that we're seeing in the market and how that's driving some of our upcoming initiatives that we're due to undertake next year. And as James said, there'll be an opportunity for questions at the end there, should you have any. So hopefully some of you are familiar with the PFI story. As James mentioned, we listed on the NZX back in December 1994, so we've been around for a long time. The company has always been focused on industrial property. Our stated purpose is that we generate income for investors. We do that by being professional landlords to the industrial economy in particular. And in turn, that should generate prosperity for all of New Zealand, which we see has been pretty important. We've got a very good track record of delivering results. Our investors have enjoyed average annualised returns in excess of 10% since we listed. So a nice long track record of delivering there, which is good. As James mentioned, we've got a current portfolio of 97 properties actually. This is leased to about 135 tenants. I think the key point I'd pull out from this slide is that the portfolio is valued well in excess of $2 billion. So we're a genuine company of scale, and that brings its own opportunities, which we've enjoyed. Got a very strong track record of occupancy. Over the last 10 years, we've averaged close to 99% or 99%. At the moment, we're at 99.5%, so we're enjoying a really strong period, which is good. We take this as a good indication that the buildings that we own are fit for purpose. Should a tenant leave, we don't have a lot of trouble attracting other tenants to fill those buildings, which is really important as we see the income that we get from our tenants has really been the lifeblood of the company. It allows us to pay our expenses and then with a little bit left over, pay out decent dividends to our shareholders. The average lease term within our portfolio is 5.3 years, and current company gearing sits at 27.6%, so well below 30%, which we think at this point of the cycle is pretty important. We've got a reputation of having a clear low-risk strategy, and this is executed by an experienced management team. Most of the people in the office down here have been involved with PFI in excess of a decade, so plenty of experience here, which again we see has been really important. The majority of our portfolio is located here in Auckland, about 85% of it. We see this as the deepest and the strongest market within the country. That said, we do have properties outside of Auckland spread throughout the country. We see that as a key point of difference to some of our competitors, is it allows us to work with some of our larger tenants who have a national footprint. We can satisfy that with buildings we own around the country. The rest of this slide really highlights some of the reasons why we think industrial property is pretty good. It's got an average size, or our average size property is about 8,000 square metres, valued at about $22.6 million. We see this as being smaller and more liquid in nature. You can buy and sell these more easily than perhaps a shopping centre or an office tower. Importantly, industrial property tends to have 1 or 2 tenants per property, rather than, again, an office tower that has multiple tenants. This means it's less management intensive, they're less harder on the buildings. And finally, from the way they're constructed, they tend to be single-level offices. Obviously, the warehouse portion is concrete and steel. They require low levels of ongoing capex and present a reduced seismic risk. We see that as very important as well. And I think the market has recognised that in the last 5 to 10 years. So here at PFI, we've got a reporting date of 31 December each year. So June 30 is when we present our interim results, and we release those in August. This time around, we reported a resilient set of results, is how we've described it. Our interim profit after tax was close to $24 million. Our funds from operations, or FFO, was slightly down on last year, and that reflected the fact that we sold a large non-industrial asset, Carlo Park, which was a mixed-use asset, for $110 million down in Parnell. So that slightly affected the funds from operation compared to last year. However, our adjusted funds from operation was very much in line, which was pleasing for the interim period. We also announced in August that we valued 11 of our properties at the half year. These properties enjoyed a write-up of close to $19 million, or 9.8% per property. That meant our portfolio yield remained largely unchanged at about 4.5%, and our NTA, or net tangible assets, increased by 6 cents to $3.09 per share, $3.10 per share. I would note, with the recent rise, or strong rise, in interest rates, that we do expect cap rates to drift out over the next 6 to 9 months. We'll probably get a question on that at the end. This seems to be the key question that we're getting at the moment. But that said, the industrial property market has been enjoying some really strong rental growth, and that's forecast to continue. I'll talk about that in the next couple of slides. And at this stage, we're seeing that that is offsetting the fall in capital values. So that's quite an important point to make. Speaking of strong rental growth, just going to touch on the current market and a couple of themes we're seeing out there. As you can see by this slide, Auckland industrial vacancy is at all-time lows. Prime vacancy sits below 1% and has done for the last 12 months or so. This low vacancy, coupled with a large increase in online sales, probably due to the COVID pandemic and the response to that, has seen strong demand for industrial space continually. These favourable conditions have provided the platform for continued forecast rental growth. In fact, CBRE, which is a real estate agency, puts out quarterly reports. They're forecasting annual growth of 5% for industrial property over the next 5 years. So we're entering into a period where elevation in rents is very much forecast, and it has in fact been quite strong for the last 3 or 4 years as well, which has been good. That tight sort of vacancy, lack of supply coming on, has meant that individual per square metre rates for these buildings, industrial buildings, has risen quite sharply in the last 18 months. And this graph doesn't really show it. This has been taken from another presentation. But particularly in the last 6 months, we've seen square metre rates for industrial property elevate very sharply. To meet this demand and take advantage of these conditions, we're looking at progressing some development opportunities within our portfolio. We call these brownfield opportunities, and I'll talk to those, particularly 2 large ones we're about to kick off shortly in the next couple of slides. But before I do, I'll just run through some of the leasing activity we've undertaken this year. During the first 6 months of the year, we completed 19 leases over close to 67,000 square metres of area for an average lease term of 5.4 years. This shows that tenants are particularly happy to sign for long periods. They're pretty confident in their business, which is important. Of those 19 leases, 4 were to new tenants and 15 were renewals. And on average, just 0.2 months of incentive per year of lease term was required to secure these transactions. And again, that highlights the current strength of the industrial market. With a positive re-leasing spread of 16% on annual passing rents being achieved, this represented an average 8.2% increase on the December 31 market rent assessments. We managed to tap into that strong rental growth that I referred to on the previous slide to our shareholders' benefit. We've also completed a number of rent reviews this year, in total 61 today, across nearly $29 million of rent. These reviews delivered an average annualised increase of 4.8%, sorry, which is very much in line with the CBRE forecasts. In the second half of this year, a further 41% of our rent or contract rent will be reviewed in some nature. And again, this gives us the ability to tap into that growing rental income. So looking forward, as a management team, we're looking at ways to take advantage of this low vacancy, the growing demand and the rising rent thematics that we're seeing play out in the marketplace. When we look at our portfolio, we split it into 4 categories. Obviously, core generic holdings, assets held for sales and specialised assets, and then brownfield opportunities. And we try to target a range of holdings. And you can see there on the slide, for instance, core generic holdings, we target between 73 and 84% of the portfolio being at that level. Currently, we're at 79%. The other categories are all within range. And then we have the Auckland, out of Auckland split as well below, and we're in the range there, which is pleasing. We do this, we view the portfolio in this way as it gives us focus and enables us to act with confidence as the portfolio continues to grow. This year, however, with increasing area of focus for the team has been that brownfields opportunities and redeveloping existing holdings. The next slide speaks to how much of our portfolio. So close to $220 million of the portfolio, or 10%, is held in these brownfield opportunities. These redevelopments are really important for us. They allow us to invest our capital into accretive projects in what we see as key locations or precincts, particularly here in Auckland. It allows us to regenerate older assets that are perhaps coming to end of life and create or develop future-proof buildings that will really serve the company for the next 50 to 70 years as if we build them correctly. So pretty key. 2 main opportunities that we've been working on this year and will sort of come to life next year. The first one is Bowden Road, 30 to 32 Bowden Road, which is located in Mount Wellington here in Auckland. Bowden Road is really one of the key industrial precincts in Auckland. It's about 15 minutes from the CBD on a good day. Has really good motorway links through to the airport and south and to the port here in Auckland. This property is 3.9 hectares in size. It's got a final lease expiry in March next year, 2023. So that's just 5 months away. We know the tenant's leaving. You can see from the buildings there, a real hodgepodge of buildings. Originally, this property was developed from the 1960s to 1970s. So these buildings are what we term obsolete. Once the existing tenant finishes operations and moves out, very little chance of securing income from a new tenant. So we're looking to redevelop the site. As you can see there from the slide, we've got the ability to develop about 20,000 square metres of warehouse facilities. Construction is due to begin in April 23. This is an estate that we're going to build out in 2 stages, stage 1 to the right, stage 2 to the left. As I look at that slide, we're developing this to achieve a 5 Green Star rating, which will be a first for us. Pleasingly, we've secured a pre-commitment for approximately 40% of the site, which is stage 1 on the right there, outlined in red. This is to a company called Tokyo Food, who are currently located in several sites around Mount Wellington. We're bringing them together to a super hub. They've committed for 12 years from commencement of the lease, which is estimated to be June 2024. So a 15-month construction period. The balance of the site allows us to develop out about 11,000 square metres of high-stud modern warehouse facilities. Some of you might have noticed we announced to the market on Friday that we're actually going to commit to developing that out on a speculative basis. So we haven't secured a tenant, but we're very confident in the market in terms of leasing. And we're confident that in the 18 months it'll take us to develop, that these rents will continue rising. We want to have some exposure to that. So that will kick off again April next year, due to finish around the same time as Tokyo Food. We have one builder across both buildings. Combined, the total project cost, or the amount we're investing into this project across this estate, is about $66 million. And we're targeting a yield on cost in excess of 5%, including the land cost that we put in there. So a pretty good project for us. We're pretty excited about that. The next brownfield opportunity we're working on is 78 Springs Road. This is located out in East Tamaki in Auckland. This is a large 10.4 hectare site in one of Auckland's premier industrial suburbs. The size of the project allows us to redevelop or refurbish multiple warehouse options from up to 30,000 square metres to smaller unit sizes and everything in between. The existing lease to Fisher & Paykel is due to expire October 2024, so we're proactively looking to redevelop this site. And obviously 2024 seems quite a long way away. It's nearly 2 years away. But we've made some really good progress on the pre-planning for that. These projects take a long time and take a lot of work to get them to a stage where you kick them off. At this point, we're estimating a capital spend of up to $150 million staged over the short to medium term. And again, we'll be targeting a return on cost in excess of 5% with the land value put in. Once again, this will be a 5-star green rated project on all new buildings. And we're looking at how we can refurbish some of the existing buildings on site and perhaps have a green performance rating on there. It's something we're working with a couple of agencies on at the moment, so pretty exciting. So that's sort of just a quick summary of where PFI is at the moment. You know, to summarise, I guess, the presentation, we're very pleased with how PFI is currently positioned. We're lowly geared, we've got full occupancy. We know our rents are growing, which is pretty pleasing. There are some headwinds out there around interest rate rises. Interest costs are our largest cost, but we're trying to, or we're hoping that we're planning to grow our income greater than the cost of the interest with these strong rental growth out there in the market at the time. Looking forward, as always, there's going to be some challenges, but we think we're really well positioned to respond to these and hopefully take advantage of the opportunities that will no doubt present themselves with a little bit of market fragility over the next couple of years. So that's my presentation, James. And I think if there's any questions, we've got 5 minutes or so that we can run through. There you are.
Thanks, Simon. Indeed, thanks very much, Simon. Great presentation. Great to hear about what kind of opportunities you're working on. And just a reminder, please do ask those questions through the chat box. So a question here, can you explain the advantages of industrial property, other types? I presume that means other types of property. I think you've maybe touched upon a number of tenants. Anything to add there?
Yeah, I guess on slide 4, we sort of touched on that. We've always been big fans of industrial property, primarily for a couple of key reasons. It's simplicity. It is generally one tenant per property. That makes it less management intensive. The capex required to maintain an industrial property is a lot lower than some of these other buildings. If you take, for an example, a shopping centre or an office there, you're continually having to put money in there just to remain relevant, upgrade lobbies, upgrade lifts, large air conditioning systems, etc. Industrial property, if it's well designed at the front end, tends to be relevant and functional for a very long time. As long as you've got good ability to unload and load the buildings, it's a reasonable stud height, so you can use that storage volume, and it's well located. Whether it's 10 years old or 30 years old doesn't really matter if we're blunt. So yeah, it's always been an attraction to us. You've probably seen that being recognised in terms of the re-rating of industrial property over the last 15 years. 15 years ago, a lot of money was going into shopping centres and office towers. Now a lot of it's been trading into industrial property for that simplicity, really.
Interesting. All right. Thanks, Simon. Another question here. I think you touched on interest rates, so this question's along those lines. How do you see the macroeconomic environment impacting on the business over the next year? I guess you could extrapolate that out as well.
Yeah.
Any thoughts?
There's a bit of there's two sort of thematics working there. There's a bit of a disconnect in terms of the wider economic. No doubt there's some volatility out there. No doubt interest rates are going up. And we're very conscious of that. On the ground, the thematics though for industrial property is very, very strong. There's very low occupancy. Tenants, a lot of the tenants are in growth mode, so rents are growing very, very sharply, which at the moment is offsetting, as I mentioned earlier, cap rates easing out. How that's going to play out over the next 12 to 18 months is the $2 billion question, really. We think industrial property is the right place to be. I think cap rates are going to continue to ease as interest rates go up. Where interest rates get to, no one really knows, is what I would say. If there's a hard landing, interest rates will come back down pretty quickly. If there's a bit of a lag, then it won't be 12 months, it'll be 24, 36 months before it sort of finds its balance. But right now, yeah, the on the ground thematics for industrial property is very strong, whilst there's some volatility in that wider market.
Okay, great. Cheers, Simon. I think we've got time for one more. Simple question here. What is your approach to sustainability?
All-encompassing, really. That's something that over the last 3 to 5 years, PFI has taken very seriously. We've put a lot of resource into it. we've created a new role nearly 3 years ago and filled that with a head of sustainability. As I mentioned earlier, not only are all new developments going to be Green Star rated, but we're actually going through our existing portfolio with a tooth comb as to how we can improve them. So we've done a lot of work around reducing R22 gases in old air conditioning systems, for instance. We're just starting the process around measuring electricity and water usage, and we'll be able to take that on board shortly. Solar, we're investing in some solar projects on a couple of properties that we own. That will be the start of a wider project that gets rolled out. But there's no doubt, you know, landlords will be the people leading this stuff going forward. You're seeing that from a capital point of view, banking, insurance is pushing into it, and then landlords are starting to lean into it as well, and then tenants will follow. So yeah, watch the space over the next 5 to 10 years. I think in 10 years' time, if you haven't got a green rated building, there will be a pretty decent split between the rents you can charge for a green and ungreen rated building. So we want to be at the forefront of it.
Okay, fantastic. No more questions there. So Simon, thanks again very much for joining us this morning. We'll catch up again soon. Enjoy the rest of your day. Thanks again.
Okay, thanks, James. Thanks, everyone.
Cheers, Simon. Excellent. Okay, and with that, we're going to move on to the second presentation today. So I'd like to introduce Kimbal, Riley, and Matt Cawte. Hi, Kimbal. Hi, Matt. CEO and CFO of Vista Group, respectively. Vista Group is the global leader in delivering software and data analytics solutions to the film industry by their core group of businesses. Their love for cinema and film drives the purpose and foundations that generate innovation for their customers and ultimately bringing more people together to experience the magic of movies and cinema. Fantastic. Kimbal and Matt, over to you. I'll be back in a few moments. Thanks.
Thank you, James. You actually did that extraordinarily well. You could do the presentation for me. So welcome everybody to the movie industry. I'm Kimbal Riley. I'm the Chief Executive of Vista Group, and I'm joined today by Matt Cawte, who's our CFO. We want to talk about what is our most important strategic project, but first of all, I need to give you a little bit of context about us, right? So if we could just move on, we'll read this important notice. And then I want to talk about our company. We are the global leader in technology solutions across the whole film industry value chain. And we describe it here as distribution, exhibition, and moviegoers. And I probably want to take the opportunity to interpret that into language that we will more readily be able to grasp. So distribution, the segment of the industry which relates to distribution, is what we would typically think of as studios. So the production of content and then the distribution of it around the world. Exhibition are cinemas, right? The places that you go to enjoy the theatrical experience. And moviegoers are hopefully most of you. So I would encourage you to get along to the cinema and enjoy that theatrical experience. It's a unique experience. And the content that's coming through now is really terrific. I thought it might be useful to kind of give you a couple of metrics which kind of, I guess, support that the idea that we're the global leader. So when we set out on this journey as a New Zealand company, our main driver was to grow our market share around the world. And in the what we call enterprise cinema space, we segment the industry into enterprise cinemas and independents. And so that's a reasonably clear distinction, I think. In the enterprise space, our market share globally is over 50%. So that talks to the fact that there are, we reckon, around about 1 billion tickets sold every year through our technology in 5,000 plus cinemas around the world and in countries that we're in is over 110. I just wanted to talk about where you might think that you interact with our technology. So if you are going to the movies, if you want to see what's on at the movies, if you want to see what screenings are up, what showtimes are up, if you want to purchase a ticket across all the different sales channels, be it mobile, be it kiosk, be it web, or standing in front of a point of sale with a nice operator from the cinema, there you'll be touching our technology. And as I said, in half the world's cinemas, the technology you'll be touching will be ours. And then if you're in the kind of, I guess, the operational side of a cinema circuit, then you're talking about how you do the film programming, which is how you decide what to show on what screen at what times, how you go through creating a loyalty program, how you go through marketing to your loyalty members, the types of movies that they need to see. Those are all the places where people touch our technology. The best and simplest way we've found to describe ourselves is the ERP of the cinema industry. So we're undertaking a significant project now, right? And I just want to talk to briefly what our purpose is, right? And I think James did this very well, is to bring more people together to experience the magic of movies and cinema by creating the platform that connects the industry and powers the moviegoer experience. And there's some really powerful and significant words in there for us around magic, around the cinema, being able to see that cinema experience, and about platform. And I want to talk a little bit about platform. So the majority of the technology that we have deployed with customers today is what we call an on-premises deployment. In other words, it's at our customers' premises, be it a cinema or a head office, and generally running on hardware or servers, or however you want to describe it, that they own and they operate. And so they're responsible for the operation of it. Right? What we are now undertaking is a significant transformation project to move from that on-premises deployment to a SaaS cloud future based on our platform. And so I want to talk to you just briefly, talk about what our platform will be, right? So our strategies, therefore, are relatively simple. First of all, we're supporting our clients. And it would be fair to say that over the pandemic, the cinema industry had a bit of a tough time with people in different forms of lockdown. It was obviously kind of difficult to get to the movies. So supporting our clients and helping them rebuild, that's well underway, right? The sentiment of moviegoing is very clear. People are actually wonderfully going back to see the cinemas, and lots more content is coming through, as Matt will describe shortly. So the core and most important strategy for us is to take that on-premises technology and to move our clients from that kind of environment to our platform, to a SaaS cloud future, which is the piece that will drive our future and opens up magnificent opportunities for us. Our third strategy is around creating and investing in new opportunities, primarily through some of the portfolio companies we have who fill in some of the other, I guess, gaps in the film industry value chain. I just want to talk briefly about platform, because we, as technologists, and I have to apologize, I am a technologist, right, tend to use words and then assume everybody understands what we're talking about. So we have a platform, we describe it as one platform, but it actually has 3 layers to it. Vista Cloud is the piece of our platform which replaces the on-premises technology that our customers are currently deployed using. So that we summarize that in a tagline, which is simple and serverless. So all the technology moves to the cloud. The client doesn't need to have the servers either in the cinema or in head office, and we take responsibility for operating. Our Vista Digital layer is about delivering the ability to do what we call online sales channels processes. And you would have all noticed, I'm sure, over the last 3 or 4 years, the move away from standing in front of a point of sale or an operator to being able to purchase online. So as I mentioned before, mobile, kiosk, and web are the sales channels which are supported by our Vista Digital platform. And in being able to target the right movies to people who would like to go and see them, the tagline, connecting every moviegoer to their ideal movie, is what our Movio EQ layer of our platform does. So why are we going through this transformation? The platform is good for our clients, which is clearly good for us, but also good for us directly. And I just want to talk briefly about why we see it as good for our clients. It enables our clients to focus on the things that are most important to them, getting more moviegoers into the cinema to watch more content more often. It gets the innovation that we build, and we build innovation every day, right, into the hands of our users much more quickly and much more easily. And 2 aspects of cinema operation is significantly reduced for our clients when they move to platform. One, the operational workload, and secondly, the requirement for CapEx. And there's something quite unique about the cinema industry, right, which makes it ideal for a cloud-based, scalable environment, which is that there's a huge variability in the transaction demand across time periods, across a week. Somewhere around 80%, slightly more than 80% of tickets are sold in a 10-hour window on Friday and Saturday night. The rest of the week is relatively quiet by comparison. If you have an on-premises deployment, you need to scale your hardware investment to cater for the peak, right? But most of the time it's not working very hard. So for being able to scale it in the cloud, which we were able to do, makes it an ideal venue for that. So good for our clients. Also good for Vista Group. It enables us to address a much greater share of our customers' technology spend. In general, we don't believe that moving to platform will necessarily greatly increase the overall amount that customers will have to spend, but it will enable Vista Group to address a much greater share of that, greater share of wallet, as we put it there, or increasing addressable market. It'll also, we believe, enable us to reduce our working capital and enable us to drive operating leverage, and it more closely aligns our success, our revenues, with our clients' success. And now I'm going to hand over to Matt Cawte, who's going to take you through how we're traveling on that journey and what the future really looks like, which will be, as I say, tremendous. But before I go to the movies and enjoy the content. It's great.
Thank you, Kimbal. I just want to talk a little bit about where the business is at today and how we're undertaking that journey, and what the last couple of years, the position we've put ourselves in means, and talk a little bit about the targets that we're setting ourselves for the long term. But kind of want to start with reinforcing that message of we're actually one of those few New Zealand and Australian tech companies who's been successfully globally, not just in the sort of English-speaking world. And it speaks to the strength of our product, and that it has been adopted in South America. In Central America, we have 94% of the cinemas running our tech. We're widely used across Europe and Asia, and we sell direct to almost all territories in the world. As Kimbal said, over 100 countries. There's only two places we don't sell direct to. One is India and one is China, because they've got different business models. But everywhere else we have we've sold successfully and achieved that market share gain leading up to 2019 and nicely into the pandemic. And that has set us up for an interesting couple of years, obviously, with the entertainment and outdoor, out-of-home markets being severely impacted by the pandemic globally. It's great to see the recovery coming back. So if you remember the slide that Kimbal said about our three strategies, strategy one is really around supporting our customers, our clients, getting back on their feet. And we've been doing that for the last year, 18 months, with new tech and new services, and a pivot to our digital tools, which is the middle layer of that platform diagram, which really connects our clients to their moviegoers more intimately. So supporting our customers and maintaining that market share has been really important, because as the market comes back, we see that the benefits of our technology are being taken advantage of by our clients. And box office has been growing consistently in the years before the pandemic, but obviously took a big hit. Interestingly, the forecasts now are for 2024 and 25 to be well in excess of 2019 and continue to grow. And the forecasts are for actually new cinemas to be built in the next couple of years, and screen growth as well as box office growth. So we're in this interesting sort of rebirthing period of the industry, and we've had some amazing success. So in the last 12 months, 2 of the all-time top 5 movies have been released in the US market. So Spider-Man No Way Home and Top Gun Maverick beat all-time records. And there have been some really good other successes across blockbusters in particular. The kind of missing ingredient, which is why 22 and 23 are perhaps held back a little bit, is the diversity of movies. But what's exciting now is the slate for the next couple of years is looking very full. So this is the slate for Q4 this year. We've seen Black Adam come out 2 weeks ago, beating expectations with a $60 million US opening. And we've seen pre-sales for Black Panther, which comes out next week, in the similar order to Top Gun Maverick and to Spider-Man No Way Home. So we're expecting good things for that. And for Avatar, of course, in December. And we've seen a lot of movies move out of the way because basically people are expecting big things. I think that's great for blockbusters. So we've got a whole list of them coming out for the next year. But also what we're seeing is the strength of the studio slates going into more diverse content, more niche markets, and hitting a broader audience. And that will really top out the return of the box office. And that's good news for our customers. And when it's good news for our customers, that means money's going over their tills. It means better use of Vista technology. Now, we don't need the market to fully recover for us to do well. At 70 or 80%, which it has been traveling at most of this year, you've seen some good recovery in some of our results. Hopefully some of you have been following that, and more of that's to come. But what a more diverse slate means is, as the box office rounds out, cash comes over the till of our customers. They get back into the investment mindset, and the main recipient of that is tech, which connects them to their moviegoers more closely. And if you think about the slide that was represented our platform, the two top layers are really around making sure we help our clients understand the moviegoers and connect them to their movies. So cash over tills from good slate means that the transition to the platform it begins to accelerate, and that's what we've prepared for. And that transition to the platform we've got here is a bit of a diagram. On the left is what the on-premise technology stack would look like for a customer. It's made up of multiple vendors, multiple contracts for hardware, operating systems, servers, databases, all those kind of things. The transition to the platform, as with any transition to SaaS, really simplifies that. It allows our customers, our clients, to focus on connecting to the moviegoers, and really simplifies their activities. And most importantly, and it was I think point 2 in Kimbal's good for the client side, it puts innovation in the hands of our clients very quickly. Instead of us developing it, deploying it into the market and allowing them to update their servers over 6 months, 18 months, we can turn it on immediately. And so there's lots of immediate advantages for the transition. And that provides a good increase in revenue opportunity for us. And so I just want to talk around what that will mean for our targets going forward. We have, as Kimbal said, about 5,100 sites, or 51% market share of the enterprise market today. We have annual recurring revenue of about $110, $112 million at the midpoint of the year. Once we've converted 100% of the market, we're expecting to be more than $300 million ARR. So just under 3 times today's ARR, and be continuing to gain market share. The business did a wonderful job of seeing off competition leading up to the pandemic, and we want to stay ahead of the game, and the transition to SaaS is all about that. It will deliver sustainable and significant revenues, and the pivot point, the inflection point we're focusing on is the end of 2024, as we've come out the top of our investment cycle and start to deliver free cash flows and the opportunity for dividends from 2025 onwards. So thank you for your time, James. That's us. We'll happy to take some questions.
Thanks very much, Kimbal. Thanks, Matt. Great to see those movies coming out, the full stack, although kind of slightly bittersweet because I've just seen Barbie's coming out in Q3 23, so I'll probably get roped into that one with my little girl. That's fine. So yes, question. Yeah, I'm probably not the only one. Right, questions here. So first up, so current technology is forever being disrupted. How do you ensure you maintain your leading position?
Well, it's actually a good question, because we took the view some time back that with the market share we had, we were in fact what we would describe in the industry as the de facto incumbent. And rather than wait for somebody else to disrupt us, because the competition that we saw was not from competitors that we saw in the market at that point, but from people that we didn't know that might be showing up. We decided to disrupt ourselves. And so this project that we're undertaking and transforming ourselves to a SaaS cloud future is about us setting out to disrupt ourselves to stay ahead of the game and ensure that we're going to be there before anybody else can get there.
Oh, interesting. Yeah, so great to hear about that transition as well. Fantastic. Another question here. You've touched on market share already, but this one's around market share. So what is the biggest opportunity globally in terms of growing market share? So I guess a nod to that map you showed.
Yes, look, we've got a couple of key target clients, but I think we call them the top 8 actually. So we've got 8 targets which are in the 49. But I think most of them actually run internal systems. I think as they develop SaaS or cloud first strategies and implement that, they'll look more and more to Vista. To target our 60% though, we haven't factored any of those in. The market share gains we think we'll make in the next couple of years are just bringing people direct into the platform from the sort of mid-size range.
Great, fantastic. Okay, there's time for one more. I think this is quite a blunt question, but I'm going to ask it. Do you think people will always want to go to the movies?
100%. Never had any doubt, and the evidence in front of us, over the last period is that absolutely people will go to the cinema, right? And I think it's worth, reflecting that the theatrical experience is an experience. It's very different than sitting on your sofa in front of a streaming platform. There is room for both to coexist, and cinemas are working really, really hard at making that theatrical experience even more unique. So yeah, we're 100% positive about that.
And it's not just that we like movies. If you look at the commentary from studios and their recent market updates, they're very clear that the theatrical experience is the only way to economically launch a large movie. So the difference will go back to, I think people will continue to experiment between theatrical releases and streaming and other options, but the studios are definitely back into getting behind cinema releases because the economics play out. It's not just a sentiment thing, it's the actual economics play out. So yeah, we're in the right space. It's great.
Great to hear. Okay, I think we'll just tie things up there. So Kimbal and Matt, thank you very much, both of you, for joining this morning. Enjoy the rest of your day, and no doubt we'll see you again soon. Thank you.
Thanks, James. Thanks for your time, everyone.
Thanks, gents. Excellent. So we're now through to our third and final presentation this morning. It is still the morning. Paul Harrison joins us. Welcome, Paul, who's Managing Director of Cawte Funds Management. Cawte is an active fund manager with an investment philosophy based upon the belief that share markets have characteristics that lead to market inefficiencies that can be exploited over time. Also to note that within Cawte's suite of funds, and I think Paul's going to talk about today, is the NZX listed carbon fund under the CO2 ticker, which provides investors with access to New Zealand's carbon market. Paul, over to you. Again, I'll be back in a few moments with some questions. Thank you.
Okay, thanks, James. Yes, I find these presentations a little distracting, really, sitting past listening to the other two. Gee, I can remember Vista, I think, came on to the NZX about 2014, 2015. I mean, I'm completely stunned. The PFI is 1994, 28 years ago. Feels a little bit like yesterday. I think we were still using fax machines for collecting our information back then. But yeah, 94 was a difficult market time for markets. It was when the Fed put their rates up unexpectedly and pulled the rug out from under equity markets. But yeah, so yes, as James said, I'm Paul Harrison. I'm from Cawte Funds Management. We've got about $2 billion of funds under management across different asset classes. But what I wanted to talk today was a quick update on the carbon fund. I did a presentation on the webinar in August last year, and I just thought it's a great opportunity. So thank you, James, and to NZX for letting me run through this. I should say before I start, none of this can really be taken as advice, please. If you have any questions, contact us or just have a chat to your advisor around investment options for this. So I just thought for those people that are on the call that are unaware, a lot of the issues around climate change have been attempted to be addressed by many different agreements over the years. The latest one that's covering the current period was signed back in 2015, known as the Paris Agreement. It was an agreement that was pretty much most countries in the world signed up to this, all attempting to keep the change in the temperature to +2 degrees, and that +2 degrees is sort of being pushed a little bit more. The ambition is for +1.5, but New Zealand signed up to this. I think it was the National Party agreed to this in 2015. So we initially agreed to cut our emissions to 30% below where they were in 2005. More recently, we've expanded expanded the level of cuts that we're proposing to do a little bit further. But the thing with this is that the world is basically we're way behind where we need to be. This data comes from Climate Tracker, and you can clearly see on their forecasts we're way behind in terms of the globe. The +1.5 degree target is got to be put into context. So this, we're already +1.1 versus where we were 150 years ago, which is the base for all of this. And I think the difficulty when we launched our fund in 2018, IPCC came out and said to people that +1.5 is going to be almost as bad as +2. So more recently, we've had another report from IPCC, which is the panel on climate change out of the UN, saying that the world has about 400 gigatons, which is 40 billion tons of emissions they can put into the atmosphere before +1.5 becomes pretty much a fait accompli. So to give you an idea of that, there's 8 billion people in the world, so each of us emitting 50 tons is what we're talking about there. So at +1.5 is quite dramatic in terms of what we will see in the changing climate, the impact on that, and I think the forecasts are so 70 to 90% of the coral reefs in the world would die off at that kind of temperature. In terms of New Zealand, our commitment, we obviously committed to cut our emissions by 30%. We're not doing very well. These charts are 2010, 2019. The 2020 and onwards is a little bit disrupted, obviously, with COVID, but as you can see, those are the big items of emissions there, the fossil fuel for transport, stationary energy, and of course agriculture. They're all trending sideways to slightly up, so there's no sign of big cuts coming through there. This is what we have agreed to initially. So this is the first 30% cut. So this is, if you say New Zealand roughly 80 million tonnes a year. We promised under the Paris Agreement that we're going to cut this down to close to 60. So you can see there's a bit of a gap there, 20 odd million tonnes over that 10-year period, 2020 to 2030. So this is the difficulty for New Zealand is twofold. One is that we have committed to this, and so there's reputation here, but there's also financial. So if we miss that target at 20 million tonnes a year, we may end up with a bill at the end of this 10-year period for 120 million tonnes. If we're going to have to go out and buy that at $100 a tonne, that's $12 billion of financial impediment to the country that we need to be aware of, and we are way behind where we need to be in doing this. So the point I've got here is that, again, this is where New Zealand's currently sitting. This is again from Climate Tracker, and they're viewing us as highly insufficient. So we're more on track to a +4 degree world, and that just doesn't bear thinking about. So again, reputationally, you can see we're not viewed very positively, which has implications for an exporting nation like New Zealand. So again, what have we been doing? We started off really well. In 2008, we established the ETS, the Emissions Trading Scheme. which puts a price on carbon emissions. We've sort of drifted around a little bit since then, although I would say now that we probably have one of the best emissions trading schemes in the world. We've improved it a lot. But again, what we can see is this is the only thing that we've got that's actually working as a country in order to set the right price signals on this. And more recently, we had the Climate Change Commission come out and say we need to be making some changes here. So basically, an emissions trading scheme is a market that's created by the government. The government assesses how much emissions that it needs to try and pull back in the sense of a budget. It'll allocate credits to forestry, which is the absorption of carbon. It will also give some free credits to the export exposed companies, whether cement factories or steel factories and such. And then it also has been auctioning off credits. So the Climate Change Commission is coming out and said, well, you're actually supplying too much into this market. The market needs to be tighter. We need to send more price signals to the market that things need to change and things need to change quickly. So, I suppose the thing for us is, as an investment company, as an investment house, why would people want to look at this? I think there's two things here. One is, if you're going to invest in an asset class, you need to understand the rules. You need to have confidence that this market is something that you can understand and you can forecast. And certainly there is bilateral support for the emissions trading scheme. The rules have been steadily improved over the years to the point where there is a little bit more certainty around what we are doing in this side of things. In terms of pricing, again, you're trying to send signals to change people's behaviour. So it's the behaviour of companies. So the price of carbon needs to be at a point where companies will invest to avoid the cost. Consumers also will want to change their behaviour if there is a cost involved. I'm not sure if many people understand that there is 20 cents a litre in your petrol price that's being paid for the cost of carbon. Your petrol is basically pure carbon. So for every litre of petrol you put in your car, it will generate 2.4 kilograms of CO2 emissions. So every 40 litres is almost 100 kgs of emissions. So people, in the end, the government's not wanting you to stop driving your car, it just wants you to drive a little bit less. I think the other important point for New Zealand is that consumers will choose products made by companies that don't harm the environment. That this is only going to get worse. As we approach 2030 and 2050, the frequency of storms, the frequency of droughts, the disruption, costs of insurance, financing, all this kind of items related to climate change is only going to get worse, and it will get much worse if you believe the forecasts. And there will be major kickback from society and looking to penalise those people that are perceived to not be doing enough on climate change. So the carbon fund, we invest in, we've got the ability to invest in anywhere in the world. Currently, we're exposed to the New Zealand and Australian markets. The fund now has just over $100 million of credits in it. It's mainly invested in New Zealand credits. We've been looking at the European market and the Californian markets, which are kind of interesting to us at the moment. They've pulled back a little bit, but I think the price for carbon in Europe is still $130 odd Kiwi, and we're just sort of waiting for opportunities in that. The fund again has performed pretty well. We think that the interesting period is coming up with the government having to decide on what it does with regards to the recommendations from the Climate Change Commission. They technically are supposed to come back by the end of the year as to whether they will accept those recommendations, and I think once we get a clearer path on that, it will be very interesting in terms of see where the carbon price goes, and whether or not we can actually get a decent price incentive to change our ways on carbon. So as I mentioned before, the mix, New Zealand units, 112 million in there. There's $3 million worth of Australian units and a little bit of cash and other in there. I think Australia is it's becoming more interesting to us. Australia, with the federal election change, they've got, the government is a lot more committed to changing how they deal with climate change and sending the right price signals in there. A little bit more water to go under the bridge though before we put too much more money into Australia. So the carbon fund itself, basically, the fund is an open-ended unit trust. It buys and holds the units. We have a registry account in New Zealand government, and in Australia. So we hold those in the carbon fund's name, so we own those directly. And by buying these units on the exchange or applying directly to us, you get exposure to the price of carbon credits. And if you want any more information, please go to the Carbon Fund website or speak to your broker. And there's the disclaimer. I think I've rattled through that pretty quickly because I suspect there may be a reasonable amount of interest in terms of maybe some questions on this. So I'm happy to take questions.
Thanks very much, Paul. Great to see that. Great to have that run through, get a bit of understanding on the market. I'm going to leave my camera off just because my internet has just dropped off a little bit, so I'm going to stay in the background. So we do have a couple of questions here. One is, does the nature of the market mean that carbon prices will generally increase over time?
I think, well, without public sort of wanting to give a forecast for anything, what you're trying to do is change people's behaviours, and they're trying to squeeze out every last little bit of emissions possible. And you know, when we started the fund, we thought you would get to a tipping point where the carbon price has gone up, you saw emissions starting to come down, and that was sort of job done really. And then we were thinking, well, you probably wind the fund up, or you find another country that you'd pick countries that were a bit behind the curve in terms of getting on top of their emissions. But you know, speaking with Rod Carr and Climate Change Commission, they want to squeeze everything out. So you know, they were at that stage, they were talking you know, $250 a tonne by 2050 for carbon, because the last thing they want you to see is you pulling the old coal burner out of the back shed and firing it up again, because you know, the price of carbon's fallen away to nothing. So it's in some ways this is a little bit like you know, people with cigarette smoking and putting an excise tax on that you're trying to really discourage people from doing something, and the last thing you want to do is to take your foot off the throat, for want of a better word. But yeah, I think in some ways that's the risk is if you let the price decline too much or at all, then that, you know, that incentive to change goes away.
Yeah, okay, yeah, makes sense. But yeah, an interesting one to see what happens over time. Absolutely. And the second question we have here is, are the domestic policy settings likely to change, e.g. with a new government? Could this affect how the carbon market operates?
I think the thing to remember here is national. I think it was Simon Bridges signed that Paris Agreement, so there is a lot of support within the opposition parties. I think ACT is very keen to sort of use a market price as very much as the sort of the prime driver of change. So if anything, there's probably more support for the ETS as it is in terms of a price setter for carbon and letting the market price emissions properly. In terms of New Zealand, so you've got there's two things here to think about. One is the domestic market and what the government wants to see New Zealanders doing, and then on the other side of it is the obligations they have within Paris. So New Zealand is currently separated from all the other markets around the world. Eventually, you would expect them to join us up to other markets. I think the first one off the block that they expect would be done would probably be the European market. At that stage, you'd probably think that you know, the pricing here and the pricing in Europe would be a little different. Would similar, a little bit different at the moment. So there's all sorts of difficulties with joining markets, but eventually you would think the price of carbon in New Zealand should be worth what, you know, cost of carbon is somewhere else.
Oh, interesting. I hadn't thought of that myself, but yeah, interesting how this this area develops over time, and yeah, certainly in line with some of the more sobering kind of stats.
Yeah, You know, when we started the fund, we would talk to, you know, because you obviously run equity portfolios, and we talked to a lot of companies around
there, something will be
what they were doing.
be ready.
Yeah. Okay.
Excellent. Paul, and as my internet again gets a bit slow, I'm going to switch my camera off. Paul, I think we're going to leave it there. That's all the questions. Thank you very much for joining us this morning. Really interesting stuff, and no doubt we'll catch up again soon. So have a good rest of the day. Thanks, Paul. And then just to conclude, thank you everyone for joining. We'll be back again next month for, I think, our final session this year. As I said, any questions you do have, even after today, or if you're watching the recording of this, you can still send those through to us, and we'll endeavour to get some answers over to you in due course. Thank you once again, and let's catch up again soon. Bye-bye.